Hey, Steve.
Hey, Paul.
It's been a while since we've talked tax.
I know I think we were trying to remember how do we actually do this. So,
I know we haven't had a chance to talk about tax theory and tax news because we've been just buried in trying to get tax compliance work done and tax returns done by those deadlines. It's been a
yeah,
crazy year. This has been a tough year, and I am so glad that 2020 tax filing season is done.
yeah, no doubt. It was, and then frankly, we finished October 15th, and I had, several 990s for exempt orders that we had to get done by November 15th. So it's kind of rolling from one into the other.
Yep. So we haven't had a chance to talk like this because of all of that stuff going on. And there also wasn't that much going on or in the news or changes or information that we thought was worth talking through, or it was so uncertain there and it changed so often. There was no need to really kind of talk about this and get this information out to our clients.
I think we were like gun shy after, California, like basically saying, oh, yeah, we're going to forgive $150,000 of PPP loans. And then it was just like scrapped at something totally different. So,
Yeah.
yeah. I know that we talked about doing it for that infrastructure bill that was passed, but there really just wasn't any tax implications really from that bill that was passed. So,
Right. Yep. That's right. So I know we kind of want to, what brought this about to kind of talk through is we finally have a picture of at least something that might be some tax law changes that would come into place. And I think it's worth us talking through and make sure we understand it. And, to the extent that our clients hear this and can, this information would be useful, that'd be great. But before we dig into that, I just kind of wanted to quickly say, with the end of the year approaching, I think there's three other things I just wanted to quickly touch on. One is for any of our clients out there who deferred payroll taxes under the CARES Act, employers were allowed to defer their payroll taxes, their employer share of payroll taxes, and self-employed people were able to defer the payment of their self-employment taxes. Those taxes are due, the first half of those taxes are due here by the end of the year. So we want to make sure that our clients are thinking of that. And we're certainly going to reach out to any clients we're aware of that have that, but that needs to be paid by the end of the year.
I think, some employee taxes were deferred too. And I think that those are due at the same time, if I'm not mistaken on that. I know that most clients didn't elect to participate in the employee portion of the deferral. If they did, it was the employer, but there still were a couple of them.
Right. And then the second thing is the employee retention credit. That's on my kind of radar now that we're through the tax filing. It's on my radar to make sure that any businesses that are eligible to claim that credit, they do take that credit. And in fact, I think that that's the one tax law change of the infrastructure bill.
Right.
You remember what the change?
Yeah, I think it ended the ERC credit after the third quarter.
Okay. So I think it's important to note that just because it ended doesn't mean that if a business was eligible for it and they haven't yet claimed it, that they can't go back and get that. So this is somewhat out of our scope because it's done on a payroll tax return, and we generally don't do payroll for our clients. So I guess I would just want to get the word out there to any client that didn't take advantage of that, their payroll service didn't bring it up, or they do their own payroll and they just didn't think about it. If they want to talk to us about whether they're eligible for that employee retention credit, we can talk about it. And we can, kind of help walk them through getting that.
Yeah.
The last thing I just quickly make sure is on the radar for some of our clients is that California AB150 law. So I think we've talked about that here, but with the end of the year quickly approaching, even though we still don't have any guidance from California, it's assumed that to get a deduction for payments under that AB 150, they've got to get those payments in by the end of the year.
Right. Correct.
Yeah. So
yeah, I think we're going to talk about that at least kind of quite a bit here because of the federal tax law changes. And even without the federal tax law changes, you've attended educational seminars and I have as well. It sounds great. Hey, let's get those tax deductions in, but it definitely feels like, and some of the speakers have said, hey, let's maybe hold off and wait this out a little bit and see how it plays out and not just rush to try to get those credits because of there's various California AMT add backs that may make that credit not as much as you think. And so you're kind of prepaying these taxes that you may not get this next year, and maybe even could be pushed out 4 or 5 years. So it might not be worth it.
right. I agree. I think I just want to make sure our clients are aware of it. And
Yeah.
I'm just like prefacing all of this to say there's so much unknown that it's really hard for us to advise our clients on what to do as it relates to this rule.
Yeah.
Um,
Hopefully we get some federal legislation here that could simplify that especially for California taxpayers that would make the AB 150 probably for 90% of the clients not,
right.
you
Yep. All right. So then that moves us then to this discussion, which is that not last Friday, but the Friday before, I believe, is the date that the House of Representatives passed the Build Back Better Act.
Yes.
And sent it to the Senate. So now that law is with the Senate, and the Senate is doing their work. And I think the process would be that then there would be some negotiation between the Senate and the House to compromise it before a bill is passed by the entire Congress and sent to the president to sign. I know that Schumer has indicated it's their plan to have this, their desire to have this done before Christmas.
Right.
What a great Christmas present.
Oh, Merry Christmas for us. Yeah. I think, the interesting thing about Build Back Better, I think that they stole that from us. I thought that we were talking about after tax season that, we were going to build back better.
Yeah, that's right.
Yeah, I don't know where they got that.
Yeah. So I guess it's worth talking about what is the tax rules in that bill, even though we don't know how what the final results will be. But I think it's a good indication of kind of where things probably will be.
Yeah, it's so interesting. We've heard rumors of this dating back, I think, to August. Where we're freaking out, and I think all of us as well, of like, how can they pull this off, and lots of RMD talk, and yet the bill as it looks right now, boy, it's much simpler and definitely doesn't include some of those radical changes that we feared.
Yeah. So I guess let's just kind of go down a few of those. The first one that I'd want to talk about relates to that AB 150. So AB 150 allows owners of pass-through entities to circumvent the $10,000 state and local tax deduction limit by paying their state taxes through their entity. Well, this Build Back Better Act increases that SALT tax limit from $10,000 to $80,000, which would, like you said previously, make that AB 150 irrelevant to most taxpayers, which would be great because that AB 150 is so complicated. There's so many uncertainties. The fees to do it would be high. So this is a relief to see this in there.
Yeah, no doubt. I think everyone would welcome this for sure in California and other high income tax states.
Yeah. You want to come up with the next one?
Okay, well, I mean, I think the next one that I believe impacts most of our clients is the fact that the net investment income tax, at least as it was called, net investment income tax, now does not just include investment income. So, all of your Schedule C businesses, S corps, flow through, all of that income, which was previously excluded from the Obamacare tax, that 3.8% tax, is now included for the taxpayers whose adjusted gross income is over $400,000.
Yeah, so not just investment income, but active, trades or businesses that people own and run would also be subject to the net investment tax.
Yes. As if it was investment, and yet it's not.
Yeah. So that's one of the themes of this Build Back Better plan is, and I'm trying not to hop on the soapbox, but there's a lot of little, death by 1,000 cuts, tax rate changes that are kind of disguised. They're not necessarily changes in the tax rates, but they're going to get people kind of without them seeing it in the actual tax rate. That's
Yeah, they're calling them like surcharges now or something, right? As if we don't want to call them taxes. They're 3% surcharges or something.
Yeah, so that's another one for taxpayers who have adjusted gross income over $10 million. And I know it's hard to play your violin for somebody with income over $10 million. It's hard to feel bad for them. So this is more of a tax policy question or discussion. So 3% tax surcharge on AGI over 10 million. I'm sorry, 5% tax surcharge on AGI over 10 million, and then an additional 3% tax surcharge on AGI over 25 million. So instead of just changing the tax brackets, they call it a surcharge. I don't quite understand the logic or the rationale there, but that's what this is.
Yeah.
The other one that I've been following is this required minimum distribution for any taxpayers that have IRA account balances over $10 million.
Yeah.
So this is, there's a famous, Silicon Valley tech angel investor, what's his name? Peter, I'm not gonna remember, Peter Thiel, I think is his name. And I think he's famously has an IRA that's like over $1 billion. So that he is invested with IRA funds and companies, tech companies, and the value of his IRA has grown to this, $1 billion number. And the IRS looks at that and wishes that they could tax that. And so they've come up with this rule where any IRA over $10 million would have to be, there would have to be a required distribution of those funds. I think half of the funds over the $10 million.
Yeah.
Basically changing the rules of IRAs. I mean, people put money into those IRAs knowing they would have to pay tax on it eventually, but when they're retired and their tax rates are lower and things like that.
Right.
So this has been on the radar, but I guess the good news in this Build Back Better Act is that it's been pushed off to tax years beginning in 2029. So there's a nice amount of time to do some planning to get ready.
I hadn't seen that. I thought that was completely off the table. So, I mean, obviously it's great that it's pushed off for 8 years, but yeah, I didn't know that they still had it on for future. Another thing I saw was the kind of closed loophole for the backdoor Roth.
Yeah.
And so, I've got several clients that, they make these non-deductible IRA contributions and then roll them into a Roth account. And so they're not going to be able to, do that anymore. So,
Yep. There's a bunch of minor changes, extending child tax credits, and I think there's an expansion of credits on energy efficient cars and things like that. There's a conformity to this global minimum tax. This is an interesting movement that's been happening where everybody, all the countries in the world agree that they're going to charge a minimum tax to avoid having, companies like Apple park their money in Ireland and things like that. So I think there's conformity to that. Some changes in the corporate tax rates.
I think the one thing you don't see in there is an increase to capital gains tax rates, because that was something that was definitely mentioned and talked about. And frankly, I had clients who accelerated income into 2020, afraid that, there was going to be this capital gains increase. We talked about it. It sounded like it was going to happen retroactive to the day of announcement back in April. So
yeah. And I think that's kind of the overall theme of this plan that the House passed, was that it seemed stunningly smaller and less aggressive than what we had been talking about for a half a year.
Right.
That seems, I've only been doing this for, 30 whatever years. That does seem to happen a lot, where they kind of set the table for these big changes and then they back way off on them. I remember, I think in the Obama administration, there was all this talk about backing off on the estate tax exemptions that George W. Bush had put into place.
Yeah.
And then the law was finally passed, there was like barely any change to that estate tax exemption. So anyways, that seems to be the way Washington does these things, is threaten something and then back off at the last minute,
Yeah. And all the CPAs are like, phew.
Yeah, and they say, wow, I wish I hadn't spent all that time thinking about that and talking to clients and planning and preparing projections for some big radical change that never happens.
Yeah, that does happen a lot. I'm trying to think of one of the other ones. I remember when they talked about like capitalization of repair policies, and we were going to have to file all those 3115 forms, to change like in the accounting principles or something related to the repairs. And then they finally said, no, never mind, you don't have to do that.
Yeah. Anything else in there you found interesting?
Not really, no. I think that we hit all the major things that are
really
hit most of our clients.
Yeah, I think maybe the only other thing is the small business stock exclusion of gain for under 1202, that gets disallowed for taxpayers with adjusted gross income over 400,000.
I guess some R&D stuff too, I heard. Sorry.
Yeah, I was just going to say that 400,000 number, we've been talking about that for a year. That's a number that Biden has said, that they didn't want to hit anybody with income under that number.
Yeah. The other one I guess we thought was the 199A QBI deduction. I don't see anything in there changing that at all. I thought that there was going to be a phase out of the QBI once a person hit $400,000. But I don't see that in what the research I see.
Yeah, you're right. And so probably what's going to happen is there'll be some, change to some of the, like maybe they'll at the last minute add that 199A thing in, and then all of our tax software companies it'll take them forever to drastically change the calculations and the reportings.
Yeah,
and we'll be it'll be March before the forms are ready to file, and we'll be going through that whole process.
Yeah. I mean, I think the biggest thing to me is I would love to see them increase the salt limit to 80,000. That would be
Yes, I agree. That's most important.
Yep.
All right. Well, probably not worth spending too much more time talking about this since it's not law yet, but hopefully this is close to where things will end up being. And of course, when the law gets passed, we'll send out a more detailed letter to our or email to our clients, as well as talk about this here, I'm sure.
Cool.
By the way, I enjoy the festive Christmas background you got going on.
I was just enjoying our conversation by the fire.
All right.
Yeah.
See ya.